other one to try to recoup those $300, so your take profit is even further away. You keep doing this and you keep losing, and you keep making your profit target so absurd that it makes zero sense with the analysis that you'd previously marked up on your charts. You are just at this point revenge trading, trying to get back your losses. What I want you to understand when it comes to revenge trading is that once you've had a loss, you need to compartmentalize that into a little nice ball and throw it in the trash can. That money is no longer yours. You should never think about it again. You lost it. It's like if you have, $100 in your pocket and it's right next to your phone, and you're at like a gas station, you pull out your phone, you check it, you hop back in, and you drive off. That $100 is so gone, you will never see it for the rest of your life. Just accept the fact that you lost it and move on with your life. Dwelling on that fact is not going to help you at all. So in order to prevent yourself from revenge trading, I need you to get a very specific tool. Get in the car, drive to the store, and buy this one thing, and it's going to change your life forever, and it is ridiculously cheap. They're called sticky notes. Now, after you've had 2 losses, and maximum 2 losses, what I want you to do is take a sticky note and write this on it. Then take this don't trade sticky note and stick it in the smack dab middle of your screen. And it is a reminder to yourself while you're still in a normal conscious state of being to not trade anymore. Because if you keep revenge trading, you'll fall into this vicious spiral. And I've seen people blow $10,000 accounts in like an hour by over trading and revenge trading, because they've already lost complete control of their emotions. But if you do this on your second loss, you are still in a normal mindset and you can actually control yourself from continuing to make those bad mistakes. Now, the third error that people do is doubling their lot sizes. This usually happens in conjunction with revenge trading. So with revenge trading, you're either increasing your take profit levels so that you can recoup the losses, or instead of making a larger take profit, what you do is double your lot size to get the same small move. So instead of risking 1%, you're risking 2%, then you risk 3%, then you risk 4%, and eventually you're risking 10% per trade, and your account will go very, very fast. Never increase your lot sizes. Always stick with the same risk percentage. And the best thing that you can do is use something like the TTF risk calculator. It basically automatically calculates your lot sizes and position sizes for you. So say you want to get into a sell position, your risk percentage is 1, your take profit is 2%. You click the sell button, and it pops up a take profit and a stop loss line. You can literally drag the stop loss to wherever you want, whether it's above the swing or a couple of points above the swing or a nice buffer zone, and it will automatically move your take profit level, and it will automatically calculate your lot size, position size, enter your trade so that this stop loss is exactly a 1% risk, and that's a 2% reward. This risk calculator comes included with TTF membership, link down below. The next issue is going to be not entering a trade or entering a trade too late. A lot of people go through this thing called analysis paralysis, where they'll be analyzing the chart, see their rejection candle or point of interest where they want to get in their entry, and then they psych themselves out. They don't enter a trade. And then the next candle starts moving in their direction, and they're like, oh, I should have gotten in when that candle closed. And then price keeps going and keeps going and keeps going in their direction. And then they finally get into a trade. They have a short retracement. They get stopped out, and then price continues in the direction of their original analysis. Here's the answer to that. If you see your trade setup and all of the confluences are in order, say you have 2 confluences or 3 or 4 confluences that you are required to have to enter a trade, and all of those things match up, make check boxes so that everything matches up. All of your confluences are in order. Enter your trade at the point that the candle closes. Everything's matched up. You're already on the chart, ready to enter a trade. You've put in your parameters on the risk calculator. The second that that candle closes, click the send order button. The reason you have analysis paralysis is because you're worried if the trade's going to play out or not. So after you've entered a trade, close your laptop, go on a 30-minute walk, brush your teeth, take a shower, clean your house, do whatever you need to do in order to not look at the chart. Come back later or the next day to see if your trade played out. Now, this is the worst one. Thinking what if after the fact. It's looking at everything in hindsight. Oh, I should have entered here. If I entered here and I would have held it to here, I would have made this much money. Or had I woken up an hour earlier, I would have seen this entry and I would have gotten it. Should've, could've, would've is a big pile of crap. Looking at the charts after the fact is easy. Thinking about what you could have done or you should have done is easy. But essentially what you're doing is telling yourself a cartoon. It's about as fictional as Peppa Pig and or Dragon Ball Z. The thing that you can do to prevent this is stick to your rules, get your 2% or your 1.5% on every single trade, and look for the next trade setup. If you do this consistently over months, years, and decades, overall you will be profitable. You will never look at previous trades that could have gotten you $68 million. It's ridiculous to think about. No way in hell would you ever hold a trade that you entered in with a scalping strategy on a 5-minute time frame to think that you were going to hold that trade for more than 100 points on NAS. Let's say the market dropped from 14,900 all the way down to 10,000. You're not going to hold a 5-minute candle entry that long. Your analysis is not that great and you're not a swing trader. You entered in a scalping trade, stick to your strategy and stick to your rules. Over time, you will build up your account, increase your percentages, and have a lot of capital and have a great life and have good income. Now, if you guys are really struggling with the psychological aspect of day trading, what I highly recommend is signing up for the trade floor, link down in the description. We have an entire section of the community that solely works on the psychological aspect of day trading because it's about 90% of day trading. There are hundreds upon hundreds upon hundreds of people in there that have the A lot of day traders make the critical mistake of hopping on the charts and then immediately seeing something and willy-nilly just entering a trade, not doing previous analysis, not spending the time to mark up their charts. And that is the one thing that you can do that's really going to change your day trading, because if instead of getting on the charts and entering a trade right away because you're in such a rush to make some money, you can sit there, mark up the charts, find the zones where you want your trade to be entered at, and then leave the charts and set alerts for those price ranges so that when the alert triggers, you get a notification on your phone, you hop back on the chart, you look at the setup, and you enter your trade and you walk away. Most professional traders do it this way. So in this video, I'm going to mark up a chart for you to see how I would do it, and then what areas I'm going to be waiting for and what indicators I can lay over that to find the best entry. Welcome back to the channel, everybody. My name is Artie, and this is The Moving Average, a show where we discuss everything day trading to keep you profitable. Let's not waste anybody's time. Hop right on the charts. We're going to be marking up NAS 100 on the 1-hour time frame. Okay, so most people hop on the charts. They get on the 1-minute chart. They see this, huge high right here. Price starts coming down. Then they see a failure to make a higher high right here, and they're like, cool, I'm going to get into a short position. And then they get into a short position. They don't even consider what time it is. And then what happens, because it's 6 a.m. right now, market just like does this and then grabs a little bit of liquidity down here and then swoops liquidity here and then goes up here, grabs all this liquidity, and then comes down here, and then the market opens, hits the equilibrium line and takes off, and you got stopped out 6 times before the market even opened because you were not patient and you didn't mark up your charts. So instead of being a complete idiot, what I want you to do is take it out to the 1-hour time frame. Fit the chart, at a relatively, like, you could see multiple months or days or weeks of price. This goes all the way back from today to the end of April. So what you can do is mark that pivot low, mark the pivot high, and put a horizontal ray on every one of these pivot points where price retraced a little bit and then shot up aggressively. Like, you want these V shapes when you're marking up these zones. Every single one of those is important because this is all market structure that price needs to get through, because you can clearly see we're in a new downtrend, and what it's going to do is sweep liquidity below every one of these points on the way down to here. Draw a trend line, 45 degrees. You can see price was trending up, failed to make a higher high, broke the trend, and is now going down. Another trend line, 45 degrees, multiple touches. Now we can get down to a lower time frame. Our bias is bearish. There are 2 likely scenarios at this point. Either it comes all the way down here, or if we take a Fibonacci retracement from the bottom to the top, it might retrace in the Fibonacci gold zone. So the most likely answer at this point is right here. Currently price is here at 14,939 and will most likely go to 14,222. That's your safe bet. I'm convinced though there's a ton of liquidity living down here. Market will continue to push down and get to this level, which is 12,713 if you're looking for a swing trade. Now we can can take it down to the 15-minute chart. And as you can see, my markup is probably going to play out perfectly. But what we need to wait for is a confluence in this area. We already have our downtrend right here. We have our level of support and resistance, or supply and demand, or order block, whatever you want to call it, they're all the same. If you disagree with me, please let me know in the comment section how those three are different. I can't wait to do clown emojis on your comments. So overall downtrend on the 1 hour, but on the 15-minute, we have an uptrend. What I'm looking for at this point is price to come back up here to test this trend line right here and come down. That's 14,953 to 14,866. That's a nice scalp. Price might reject off of that, come up, wick out of this trend line to capture liquidity above this zone, which is also known liquidity right here, which it already grabbed a little bit of. As you can see, me hovering over that previous high, you can see that the wick just barely tapped above that zone. So now there's even more liquidity above here. There's a high probability it will wick above that and reject down. That's your first price target. It will reject off of that and then continue down. Then come back up in a huge upswing, making people think it's a bull market while continuing with the overall hourly downtrend, and then break down some more. Come up to retest, break down. That's how I see this price going. So now we can add some indicators to help us identify things that we wouldn't normally see with our naked eye if we're either unskilled enough or we just like the additional help. The TTF SMC toolkit is really helpful when it comes to smart money concepts, theories, and techniques, looking at the market open price, the midnight line, as well as each market session's first hour of the open. That is known as the DR and IDR range. For example, the first hour of London session, that range that it creates right there, once it breaks above that range or below that range, it will usually trade that for the remainder of the day. So we had the London session right here on this area of support and resistance, supply and demand, or an order block, shot up, broke above that zone, and remained trading up the remainder of the day. So once it broke that zone, you could have simply targeted the next blue line that we had drawn up. New York session's opening range, price came up, came down, grabbed liquidity below this swing, retested the trend line, and shot up. Broke above that zone and remained trading up for the rest of the day. This is Tokyo session. Tokyo session usually stays relatively flat as there is low volume in the market. So now the next session that we're waiting for is going to be London session. As you can see previously here, we had Tokyo session remaining relatively flat, coming down, and then shooting up. So now we have Tokyo session remaining relatively flat, coming up. It's most likely going to grab the liquidity above this zone, and then London session is going to open and it's going to go down. Because as you can see right here, we had that Tokyo session, price came down. If we look at the low point right here where it made its first rejection, creating that trend line, it simply just grabbed liquidity below these wicks. So now we have very obvious liquidity here with the overall hourly downtrend. So between now and 9 a.m., we are looking for price to come up to our trend line and reject below our blue support and resistance and take a short trade for today. Now, if you're curious about what candle exactly to get in on, you can use buy sell indicators, either the ones that we've created or whatever your favorite is that you're using right now according to your back tested strategy. But what I'm going to put up on the charts is an indicator known as Happy Trail. I'm going to choose case 3. This will give me signals on the chart that I'm on, as well as a higher time frame confluence on the 1 hour. So because we were in this short-term uptrend with the overall downtrend right here, so our short-term bias was an uptrend, and because we're scalping, we can still snag a couple of points up to our support and resistance zones. One thing to keep in mind, we do not trade the first opening hour of any session. It is an absolute no-no. So price came down, grabbed liquidity, and then we got a bearish signal right here. We don't take the bearish signal because our short-term bias is bullish up to this trend. Take a long position at close of candle, target that zone, 1 to 2.3. So now we are waiting for price to get back up to this zone. So what I'm going to do, since I marked up my charts, I know what direction I'm planning on trading for the day. I want price to come back up here to 14,954. And at that point, I'm looking for a wick to break above this previous candle's high. So I'm just going to hover over this price, go all the way to the right-hand side and hit this plus icon and add an alert on NAS 100 at $14,954.83. That alert will happen when price crosses that point right here only once, and it will send an alert on my app on my phone, show a pop-up, or you can select sending an email or playing a sound, or it can send you a text. And now what you can do is go to the gym, work out, do whatever you want, and wait for price to get to an area where you actually want to enter a trade, instead of sitting here, entering a short position and getting stopped out here, then entering another short position and getting stopped out here, and then feeling dumb because you got stopped out twice, and then taking a long position, and then it wicks up above here, grabs liquidity, hits your stop loss again. Just wait for price to get to an area of interest for you according to your markup, and you'll be good to go. This has been a short public service announcement on how to not be an idiot. I am not exaggerating when I tell you that I get over 500 messages a day from people telling me, hey, why didn't this trade work out? Why didn't this trade work out? And it's constantly the same exact mistakes over and over and over and over again. And absolutely, I need to make this video. This is the top 10 mistakes that happen every single day that I see traders making that you need to stop. You need to watch this video 55 times. Welcome back to the channel, everybody. My name's Artie, and this is The Moving Average, a show where we discuss everything day trading to keep you profitable on a consistent basis. Over 90% of day traders fail, right? If 90% of day traders are failing, and they're all making the exact same mistakes, and I have access to their mistakes because they send them to me via DM, I'm going to share that with you guys because that's very important to know. It's super important to know how to trade, but it's also equally important to know how not to trade. And these are the top 10 mistakes. Let's just jump right into it. Okay, so I'm going to use the same currency pair for every single one of these mistakes. Every single one of these mistakes happen on anything. You could be trading Bitcoin or Tesla. I don't care. Same mistakes across the board. This is Australian dollar, US dollar, and people see the price move down past the 200 moving average. It's got great momentum. It's moving, it's moving, it's moving. It comes up to retest. It goes down again. It comes up to retest, and they're like, okay, now I'm going to get into the trade. So their position looks like this, okay? And I'm like, what are you doing? You missed the entire move. Like, you missed the entire move, and then it went into this consolidation range, and then it's going to go up. Like, why would you wait? And I know exactly why people do it. It's because they're not confident in their trade, and they watch the price go down. They watch their entire trade blow right past them, and then they saw the rejection, and they're like, oh yeah, it's going to happen. And then they wait even more, to the point where they've waited 6 hours to get into this trending market, and it goes against them. This happens every single time. This is why I say you only need to focus on the first move past the 200. That is your highest likelihood of getting this chunk of trade. Catching 10 pips in this range is way easier than trying to catch 20 pips at this range. Please, for the love of God, if the move looks like this and you've been in a downtrend for a really long time, don't trade it. You've already missed the move. Sorry, Charlie, you gotta wait for the next one. The second most common mistake is people trying to trade these divergences and not waiting for a trend line to break. Listen, when a price is trending down, right, and you're creating lower lows constantly lower lows, constantly lower lows, and on the RSI, you're making higher lows. This is a trending market, and you're trying to fight a trending market. You need to wait for the trend line of the trending market to break before you get into a divergence trade. What that looks like is this. We have a trend line. We have lower lows. We have higher lows on the RSI. The trend line broke, retested, and went up. Wait for the price to break this damn yellow line and retest it. The next, and literally the worst mistake that every single trader has made in their life, and that you are probably still making, is trading without a stop loss. It is literally the stupidest thing that you can do, and I'm going to show you exactly why right here. Market was in an uptrend. You see these big engulfing candles down, and you're like, hell yeah, this thing broke the trend line. I'm going to target this low point right here because, you know, why not? And I'm not going to put a stop loss in. So that's what my trade looks like. Enter trade, and I'm gonna go grab a coffee and then I'm gonna watch this thing play out. And you come back a few minutes later and your account is either completely at zero and blown, or you're in such a deficit that it hurts your guts. Your insides are like rotting and you're crying and you're emotional because you didn't trade with a stop loss. If you would have had a proper stop loss on here, you would have lost 1% as opposed to 100%. This is the difference between a good trader and a bad trader. Now, mistake number 4, like everybody pretty much goes through this. You see the potential of trading Forex and you're like, man, if I start with a $20 account, I'm not going to really make any money, so it's not worth my time. That's where you're wrong. That's where you're learning. So what people tend to do is take $1,000 or $5,000 from their savings account, and they're like, with a $5,000 account, I can trade one whole lot size, and I'm gonna make a ton of money on every single trade. And that's the first time that you've gotten into trading real money and you don't understand the emotional aspect and the psychology that comes behind trading with real money, and it's gone. It's gone. You literally just threw it away. So what I need you guys to do is stop depositing so much money and actually start off with that $20 account or that $50 account. Only trade money that you are absolutely willing to lose, because the first time that you put money into the markets, I 100% guarantee you're going to lose that money. But you're going to learn so much from that one experience. The next mistake I see people making is way too many indicators. Your charts usually look like this. I know that there are millions of indicators on TradingView, but that does not mean that you need to use them all. You need to pick a strategy and pick 1 or 2 indicators that really like gives you the confluences that you need to enter your trade. Having your chart look like this makes me not only want to puke, but is going to make you confused, because a lot of these oscillators are momentum indicators. So they're literally just telling you the same thing. You have 8 indicators on the bottom half of the chart that show you the exact same thing. Stop doing it. Clean up your charts, use a couple of moving averages and 1 oscillator. That's all you need. Now, the number 6 mistake on this list irritates me more than you guys will ever understand. I read every single comment. I read every single DM, and there are hundreds of them. And I get this one the most. So I will put out a video on how to scalp on the 5-minute time frame using this strategy. And I have specific rules for that strategy. And then people are like, so I watched your video and I saw that you were using the smoothed moving averages, but can I use the exponential moving averages and do the exact same thing? Well, shoot dang, partner, I see that you were marking up them support and resistance levels on the 1-hour time frame. I'm wondering if I could do it on the 1 minute. Dude, I see that you were going for like a 1-to-2 risk to reward ratio. I'm wondering if I could do like a 1-to-50.
So, I know that you said that this was only going to work on Forex pairs, but can I use it for crypto?
If somebody gave you a step-by-step recipe on how to bake a cake, literally just follow the recipe and you'll have a good cake. Don't put tuna fish inside of it. And that's my rant for the day. The number 7 mistake that I see people making is the fact that they think that they're going to get rich quick because they saw some video on the internet on how to day trade, and it is the wrong thing to do. You want to change your career path from what you're doing now to being a full-time day trader, but you want it to happen overnight. It is literally impossible. No basketball player was just like, oh, I'm great at basketball, I'm going to be in the NBA tomorrow. It doesn't work that way. This is a really difficult thing to learn. It is a really difficult thing to do, and you need to commit to it. You need to be consistent, and you need to give it the time that it requires, because if you have the audacity to think that $5,000 a month income is just something that you should be granted because you're now a day trader, you're wrong. This takes a lot of time and a lot of practice. I've spent thousands upon thousands upon thousands of hours learning this. And I've also lost a ton of money along the way making these exact same mistakes. We've all done it. These are the growing pains that you go through when learning. The number 8 mistake I see people making is not demoing for any length of time and not tracking your trades. People get into a demo account or a live account and they just start trading randomly and they're like, oh, I lost, I won, I lost. But you have no idea why you won, why you lost. You're not tracking your trades. So how are you supposed to know if your strategy is going to be good long term if you have no statistics to back it up? You need to get on a demo account. You need to pick a strategy. You need to journal every single trade, why you entered, what time you entered, everything about it, and then do a recap. If it hit take profit or if it hit stop loss and why. Do that for a month on a demo account every single day, then look at the statistics, and I promise you, you will go from being a D- trader to like a B+ trader. It is the biggest thing that you can do to increase your skill level. The number 9 mistake I see people making is so common, and I completely get it. You try a strategy and then you win, right? And then the next time you try it, you lose and you're like, nope, this strategy is garbage. I'm going on to the next best thing. Or you try a strategy and you lose on the first one and you're like, no, this thing's a pile of junk. But that one may have been the best strategy on planet Earth. You have to understand that every single strategy has a win ratio and a loss ratio, like win to loss. Sometimes you lose 20% of your trades, sometimes you lose 40% of your trades. If you are above a 50% win rate on a strategy and you have proper risk management, you are a profitable trader. You have to understand that every single strategy has losses. No strategy works 100% of the time. It does not exist. Period. Stop jumping from strategy to strategy. And the last mistake on the list is people giving up. I get DMs every single day from people saying, maybe day trading is just not for me. Oh, I can't figure this out. What you need to do is think like a child. A child that is learning how to walk will not give up. It won't just sit there and say, maybe I'll just never walk. I can't figure this out. You need to get into a mindset that anything is possible with enough practice and dedication. Don't think that you can just quit, because if you have the quitting mentality, you're going to have the quitting mentality for everything that you do in life, whether it is a weight loss goal, whether it is a relationship. All the problems in your life, if you just quit trying to fix them or quit working on yourself, that's a really deep topic, but I promise you, you're going to be massively dissatisfied with your existence if you keep quitting. So stick with it. Work your ass off. If you want to make good money in your life, if you want financial independence and financial freedom, you have to commit to things, and not commit for a week or a month. You have to commit for the rest of your life. So basically, if you want to learn how to day trade, I have over 100 videos on this channel of different strategies, whether it's scalping or swing trading or naked trading or indicator trading, whatever floats your boat. I need you to watch every single one of the videos and see which one speaks to you, because demo that strategy, and if it doesn't work out, come back and choose another one. My favorite one and my suggestion to you is start with this one. And if you guys enjoyed this video and you got some value out of it and you like the way that I teach, consider subscribing to the channel by clicking this button right here. Thanks so much for watching, and we will see you in the next video. Everybody gets stuck at one point or another in their lives. If you don't have the guidance in your life, if you don't have the mentors, if you don't have the quality people that you need to have around you in order to thrive physically, mentally, emotionally, you're gonna be stuck. I'm gonna tell you right now that your situation may be other people's fault, but it is your responsibility to fix it. Welcome back to the channel, everybody. My name's Artie, and this is The Moving Average. The week has come to an end, so you guys know what time it is. Let's get into Focus Fridays. If you're unfamiliar with the show, every Friday I like to drop a little bit of motivation and inspiration to help you progress in your life. By this point, you guys probably know me pretty well, and you know that I'm obsessed with reading books and like absorbing information from other people that have had far more life experience than me, because I've never had mentors, because I've never had an individual person to help guide me in life. I had to look towards books, the internet, online research, all of those things that I had access to at my fingertips that weren't from somebody else. Just to give you a basic idea, this is what my book library looks like. The 4-Hour Work Week, The Science of Getting Rich, The Power of Now, Your Inner Awakening, The 4 Agreements, Start Something That Matters, Ask and It Is Given, Scary Close, Unshakable, Crush It, Money, Master the Game, The One Thing, 10 Pillars of Wealth, Crushing It, Flow, Choose Yourself, Millionaire Success Habits, The Subtle Art of Not Giving Up, Expert Secrets, Start with Why. I think you guys get the picture. When you read a book written by somebody that has a collective life experience, they are at the end of their journey and they want to share their progress with someone else. They want to share their story with somebody else. You can absorb 50 years of knowledge, education, and experience in one book, and you can cherry pick what works best for you or what resonates with you the most, and you can use that in your tool belt, in your arsenal of becoming the person that you want to be. Now I'm going to get